Welcome back to the Pro Ticker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. All right, this week kicks off with quite a task for us. We're digging deep into a stack of reports, CNBC, Bloomberg, Reuters, trying to piece together what's really moving the needle today, Monday, November 10th, 2025.
It's quite a mix, isn't it?
It really is. We're looking at the immediate market reaction to, well, some potential stability in U.S. politics. Then there's the ongoing volatility, maybe nervousness in tech and AI, big shifts in global trade, too.
And that fascinating report on the darker side of the huge boom in global wealth.
Exactly. So quite the synthesis mission.
Yeah, and you've hit on the core tension there. It feels like a classic relief rally, you know. The political risk seems lower, but underneath all that structural anxiety about inflation, growth, governance, it's still bubbling away.
So our job is to help you, our listener, sort the temporary noise from the real signals, the genuine shifts.
Precisely. What matters long term.
Okay, let's jump right in with the biggest relief factor. The U.S. government shutdown. Looks like it might actually be ending.
It seems that way. The Senate passed that first crucial procedural hurdle.
A deal to fund the government through the end of January. This shutdown started way back, October 1st. Record-breaking stuff.
And that procedural vote, 60-40, is telling. CNBC highlighted that.
What's the significance there?
Well, having 8 Democrats cross the aisle, it suggests the political pain of keeping the shutdown going was just getting too high for everyone,
Right.
regardless of any leverage, you know.
Right. So the immediate win is federal workers get paid, furloughed or not.
Yes, pay is guaranteed. And importantly, the SNAP program food assistance that's funded through September, which is huge.
But there's always a catch, isn't there? We saw this in Yahoo Finance and Bloomberg, the healthcare piece.
Ah, yes, the enhanced ACA tax credits, a key Democrat demand.
Excluded.
Excluded from this immediate deal. Republicans have guaranteed a separate vote on it, but that's in December.
So, kicking the can down the road a bit, another political fight brewing for later.
Pretty much. And look, the chaos this shutdown caused, the SNAP situation is just a perfect, painful example of why this deal was so urgent.
Explain that chaos for us. 42 million Americans relying on this.
Okay, so basically there was a Supreme Court pause on a lower court ruling that said full benefits had to be paid. Because of that pause, the USDA had to tell states, hold on, actually undo those full November payments you were processing.
Wow. Administrative nightmare.
Complete turmoil for states, for recipients,
Mm-hmm.
and even though an appeals court, as Reuters reported, slapped down the administration's attempt to block the original ruling again, that Supreme Court pause, it's still in effect until at least Tuesday night. So the confusion isn't quite over yet.
Just massive instability around such a vital safety net. Okay, staying with U.S. policy but pivoting slightly. Tariffs. President Trump floated this idea, a tariff dividend. Maybe $2,000 or more for Americans?
Right, and Bloomberg had Treasury Secretary Scott Bessent talking about how that might actually work.
It's not just a check in the mail.
Seems not. Bessent suggested it could come through various tax cuts already in their big economic policy bill. Things like no tax on tips or on overtime pay, maybe making auto loan interest deductible, stuff like that.
Interesting timing, though, isn't it? This dividend idea surfaces just as the Supreme Court is hearing arguments to potentially kill the tariffs altogether.
Exactly. That's the fascinating political layer here.
Yeah.
Are they trying to soften a potential blow? If the court strikes down the tariffs, they lose that revenue, but maybe they can point to these other tax cuts as the dividend instead.
Clever maneuvering. It ties the domestic politics and the trade policy together neatly.
It really does.
So how did the markets digest all this? The potential end of the shutdown, even with these, lingering issues, stability usually wins, right?
Oh, absolutely. The stability signal was welcomed everywhere. Europe, Asia, strong rallies. CNBC noted the Stoxx 600 in Europe was up, 1.2%?
Okay. And bonds, treasury yields.
Yields rose, which means demand for those safe haven assets eased off. The 10-year Treasury yield was up about 4 basis points, hitting around 4.14%.
Just quickly for our listener, 4 basis points on the 10-year. What does that signal in plain English?
It means the price of that super safe government debt is falling slightly. Investors feel less need to hide there. That little 0.04% move just shows risk appetite is coming back a bit now that the immediate shutdown threat seems to be fading.
Okay, but here's the puzzle. Bloomberg pointed this out. Gold went up. Second day in a row, trading above $4,070 an ounce. Shouldn't stability hurt gold?
You'd think so, but the market's juggling different timelines here.
How so?
Okay, relief on the political front, yes. Tick. But investors are also looking at the underlying U.S. economic picture. Consumer sentiment looks weak. Labor signals aren't great.
Mm-hmm.
And they're betting that weakness is serious enough that the Federal Reserve might have to cut interest rates next month.
So the Fed rate cut expectation is outweighing the shutdown resolution.
Exactly. Gold gained because the bet on a Fed cut, driven by fundamental economic worries, was actually stronger than the relief about the short-term political fix.
So Congress gets its act together, but the market's basically saying, yeah, but the economy might still need help from the Fed anyway.
That's the signal, precisely.
Oh,
the
yes.
underlying economic concern is the bigger driver right now than the immediate political stability.
That structural anxiety you mentioned earlier, clearly still there. All right, let's broaden out. Asia saw some optimism, too. South Korea's Kospi jumped over 3%, kind of shaking off last week's tech weakness. What about China?
China had some, mildly encouraging inflation news. CNBC reported their October Consumer Price Index, the CPI, came in at 0.2% year-on-year.
Which beat expectations.
Yeah, expectations were for zero growth. So 0.2% isn't exactly roaring inflation, but it's the first time consumer prices have actually grown year-on-year since June. A small sign maybe deflationary pressure is easing off a bit there.
Okay. And at the same time, we're seeing tangible signs of that U.S.-China trade truce holding, the one from the Xi-Trump meeting back in October.
Definitely seeing follow-through. Reports from both CNBC and Bloomberg show China has actually rolled back some restrictions on exporting critical minerals.
Things like rare earths, lithium battery stuff.
Exactly. The material's vital for the tech supply chain. That's a big move. They also eased up on certain Xperia chips. And separately, the U.S. and China suspended port fees on each other's ships for a year.
And China paused some maritime investigations.
Right, like shelving sanctions against U.S. units of that South Korean shipbuilder, Hanwha Ocean. It feels like a very deliberate, multi-pronged easing of tensions.
So supply chains might be a little easier, but back here in the West, those worries about AI valuations just won't go away, will they? The Nasdaq dropped around 3% last week, biggest weekly loss since April.
Yeah, that AI valuation cloud is persistent. Are we in a bubble, or is it just a needed correction? That's the big debate.
What are the arguments?
Well, you have people like DBS CEO Tan Su-shan warning about a potential bubble burst. Her point, highlighted by CNBC, is the sheer concentration trillions of dollars tied up in just 7 massive stocks.
And Goldman CEO David Solomon also chimed in.
He did. He predicted a pretty significant drawdown, maybe 10–20% in equity markets sometime in the next year or two.
Okay, 10–20%. Sounds scary, but honestly, isn't a correction like that kind of normal? Especially after the run-up we've seen. Is this really a bubble warning or just a reminder that markets don't go up forever?
That's the crucial question, isn't it? If you dig into the analysis, like in the CNBC Daily Open piece, the really intense bubble fears often seem focused on maybe the pure play hardware companies or newer firms with, less proven revenue streams.
Right.
But the counter-argument from many analysts is that the earnings from the big, established tech players actually integrating AI, they look pretty solid. Reassuring was the word used.
So pullbacks are buying opportunities for the established names.
That's the argument. It suggests the profitability from AI for the big guys is real, even if some of the newer, more speculative bets are looking a bit frothy.
And this AI focus isn't just market talk, it's reshaping companies. Yahoo Finance highlighted Elon Musk's huge pay package getting approved at Tesla.
Yeah, that approval, despite all the controversy around the sheer size of it, is really seen as a massive vote of confidence in Musk's vision to pivot Tesla.
Away from just cars.
Exactly. Towards being an AI and robotics powerhouse. He talks about a robot army. The market seems to be valuing Tesla less on today's car sales and more on its potential as like a platform for AI and robotics down the line.
Okay, fascinating pivot. Let's switch gears now to something that really taps into that governance and structural anxiety theme. The rise of family office imposters. This came from a CNBC report. First, what exactly is a family office?
Right. So traditionally, a single-family office, or SFO, is set up by an ultra-wealthy family to manage only their own money, their fortune.
Just their own assets.
Correct.
Yeah.
And crucially, because they're not managing public money, they're often exempt from a lot of the usual public regulatory oversight and registration. This creates what the report called an information vacuum.
And the scale is huge.
Massive. Deloitte estimated around 8,000 single-family offices globally in 2024, potentially growing to over 10,700 by 2030. And the assets under management, currently estimated around $3.1 trillion, projected to hit $5.4 trillion by 2030.
Wow, $5.4 trillion. Can you put that number in perspective for us?
Well, think about it this way. $5.4 trillion is almost the size of Japan's entire annual GDP.
Mm.
And that amount of wealth is being managed privately, often with very little public transparency.
Okay, so that scale and lack of transparency, that's what's fueling this imposter problem.
It seems to be a major factor, yes. The sheer amount of money is obviously a target.
Is it just about financial fraud, though? Or are there other motives?
According to the industry veterans CNBC spoke to, it's actually twofold. Financial fraud is definitely rampant. They cited a case in Singapore, someone running a $10 million scheme, impersonating executives from a real firm, Man Capital, to trick people into fake pre-IPO tech investments.
Right, because genuine family offices don't ask the public for money.
Exactly. That's a key point.
Yeah.
But the second motive is, believe it or not, ego, social status.
Status, how does it work?
People literally pretend to be running a single-family office just to hang with a crowd and be somebody, as one expert put it.
Yeah.
If you claim that status, suddenly banks, asset managers, they all want to talk to you, court you, treat you well, it provides instant respect.
So for our listener, maybe someone in finance or investments who might encounter these types, what are the clear red flags? How do you spot a fake?
Okay, a few key things from the experts. First, regulation. If anyone's asking for third-party money, check their license. In Singapore, for example, the Monetary Authority says they need a capital market services license. Always verified.
Makes sense. What else?
Second, use the community. Call around. Ask established known families or players in that region. If nobody's ever heard of this supposed family office, big red flag.
Okay, check the license, check the network. Any behavioral tells?
Yes. Genuine family offices are usually very private. They're the ones being pitched to, not the ones pushing products or their status. So if someone seems overly eager to prove their legitimacy, maybe leading with some long, rambling, 400-word spiel about who they are, that overcompensation is a huge warning sign. They're trying too hard to sell you on their status because it might not be real.
That's really practical advice, exactly the kind of actionable insight we aim for. Okay, wrapping up our global tour, let's touch quickly on regulation in digital finance. Reuters had a piece on the Bank of England and stablecoins.
Right. The BOE is trying to bring more structure to how widely used stablecoins operate within the financial system.
What are they proposing?
Well, one key thing is allowing issuers of these big stablecoins to invest a decent chunk, up to 60% of their reserve assets in short-term government debt. This helps integrate them more, makes them potentially more stable.
And maybe offering central bank support in a crisis?
They consider that too, yeah. Offering liquidity facilities from the central bank itself to systemic issuers during market stress, that would be a pretty major backstop for the crypto world.
But there's still a point of friction, isn't there? Something setting the UK apart.
There is. The BOE is sticking with a plan that the industry doesn't love. Temporary caps on how much stablecoin individuals and businesses can actually hold. You don't see that kind of limit being proposed in other major financial hubs.
And smaller, non-systemic stablecoins.
They'll stay under the Financial Conduct Authority, the FCA, not the main Bank of England. So stablecoins used mainly for, say, buying and selling other crypto tokens, they fall under a slightly lighter regulatory touch.
Okay, so let's pull all these threads together. We've got the shutdown deal providing relief, but persistent AI valuation worries. We have tariff politics and easing U.S.-China trade tensions, and this emerging risk in private wealth management. What's the core takeaway for investors today?
I think the key is distinguishing between the political noise and the structural realities. The market's enjoying a breather because the immediate political risk of the shutdown is lower. That's real. But the structural concerns haven't gone away.
Like potential economic weakness forcing the Fed's hand.
Exactly. Or the extreme concentration risk in tech valuations. And, importantly, this growing governance risk highlighted by the family office imposter issue. It means these relief rallies. Treat them with a bit of caution. The underlying structural challenges are still very much in play.
A very clear synthesis. Thanks. Now, I want to leave our listener with a final thought, something tied to the big event starting today. The COP30 Climate Summit in Brazil. CNBC noted something interesting.
Yes, the U.S. presence, or lack thereof.
Right. No high-level U.S. officials confirmed to attend. But does that vacuum create an opening?
It seems like it might be galvanizing the corporate world. We saw reports CEOs from huge global companies think DHL, Vestas, the wind turbine maker, they're stepping up, calling forcefully for policy, specifically a global carbon price.
Arguing that a clear price signal is the best way to drive emissions cuts, regardless of who shows up from government.
Precisely. Their argument is policy drives action faster than rhetoric. It really makes you wonder,
Mm.
if government leadership is inconsistent, does the push from major corporations demanding clear economic signals like a carbon price actually become the most powerful force for change on something like climate?
A really interesting dynamic to watch. Okay, that wraps up our deep dive into today's headlines. We'll see you all tomorrow morning with new headlines from major financial magazines.